So this is the third in a series of lectures. I made this last week, so it reflects the data collected as of last week on the economic crisis. I plan to make one last video by the end of this week that will just kind of cover any additional updates. So, where do we go with this? What we're kind of dealing with at this point as a economist is now the really uncertain things of how do you start an economy back up again after having been shut down for so long, and what do we think that the future will look like? Is it going to be just a bad second quarter, which would cover March to June? Is it just going to be bad in April, May, and June? Is it just going to look bad April, May to June because of all the hangover from the shutdown, and then by end of June everything's back up and running again? Or is it going to be something that's bad for a much longer period of time? I know some would like to think that it's very obvious it's going to be one or the other scenarios. It's not really that. Obvious, at least to me, and at least to other economists that I know. It's not obvious. It could be that there's been enough fiscal and monetary policy stimulus to get that scenario. But unless you get things correct on the health side, which is the big unknown, right? Like testing and not cures, but testing and ability to isolate and not have those other individuals start another stage of the virus, you're probably going to more likely have this situation. So what we're trying to do now as a society is invest in enough things to make it the first scenario rather than the second scenario. But when you look at it right now, for the month of April, it obviously looks pretty bad. And most of that badness is, especially here in Hawaii, is unfortunately the top bullet point would be exactly what's where the job losses are hitting the highest. The latest statistic I saw is that April jobs data reveals that the unemployment rate in Hawaii is approximately 37%. That would be 1 in 3 workers are unemployed right now, with the majority of those being in the food and hospitality and tourism industries. But what we're seeing now, and what's becoming a little bit scarier, is that is now spreading to other sides of it. So that would be now, if those who were unemployed first, way back in March, right? Let's say like hotels and restaurants. Well, those individuals, yes, they will get unemployment, but they will start spending less. And so that would mean then that those businesses will start to get rid of some of their workers. I'm a state employee, obviously. There is a hiring freeze, and there's also even talk of furloughing us as state workers. Well, that would mean, right, if I end up being furloughed, that would mean that I'm eligible for unemployment insurance, and right, I would be counted as part of the unemployed, not to the extent that I'm completely unemployed, but to the extent that I'm not getting all the hours that I was promised that I would be working. And you even see healthcare hospitals. You would think they do great business, but no, actually, Hawaii Pacific Health, Kaiser, Queens, they make most of their money. Most of their profit comes from the elective surgeries, right? Like, plastic surgeries and, hip replacements, knee replacements. Obviously, those aren't elective, but the other kinds of surgeries, right? So then if they have to cancel those because they have to preserve the materials to treat COVID-19 patients, that means you're going to lose a lot of money. And one of the pressure points here is that you're seeing this like call for the economy just to open up again, but you also have to be somewhat concerned, because what that can mean for part of this would be that the longer that things are shut down, the more that you have to start to be concerned about. Sorry, I'm just tightening the microphone here. The more you have to be concerned about the recession becoming even deeper. So look at this projection here. So this is the latest projection we have. This just came out earlier today. I just grabbed this earlier today. That would show that non-farm payrolls, meaning how many people do we have working, had been increasing. So in the United States, we have about 330 million people, and so the idea was that we'd have about half of the total population working. That's a pretty good number. Look how that dips in the span of just half a year between 2020 and 2021. It decreases by some 20 million or so. And then only slowly, all the way out till 2023, do we actually come back to where we were in 2020. Amazing. An amazing historic drop. Okay. So one thing I'd mentioned here is that we then have the fiscal policy and the monetary policy that's all happening here. So let's start first with what's going on the monetary policy side standpoint. I just want to play this very short video here just to talk about what the central bank, the Federal Reserve, is doing to stimulate the economy, and then I'll talk about it. This would be our Federal Reserve Chairman, Jerry Powell. Not this, that's a vehicle. I don't know who that is. Nor that. That is indeed true.
Like other countries, we are taking forceful measures to control the spread of the virus. Businesses have shuttered, workers are staying home, and we have suspended many basic social interactions. People have been asked to put their lives and their livelihoods on hold at significant economic and personal cost. We are moving with alarming speed from 50-year lows in unemployment to what will likely be very high, although temporary, levels. All of us are affected, but the burdens are falling most heavily on those least able to carry them. It is worth remembering that the measures we're taking to contain the virus represent an essential investment in our individual and collective health. As a society, we should do everything we can to provide relief to those who are suffering for the public good. The recently passed CARES Act is an important step in honoring that commitment, providing $2.2 trillion in relief to those who've lost their jobs, to low and middle income households, to employers of all sizes, to hospitals and healthcare providers, and to state and local governments. And there are reports of additional legislation in the works. The critical task of delivering financial support directly to those most affected falls to our elected officials, who use their powers of taxation and spending to make decisions about where we as a society should direct our collective resources. The Fed can also contribute in important ways by providing a measure of relief and stability during this period of constrained economic activity, and by using our tools to ensure that the eventual recovery is as vigorous as possible. To those ends, we have lowered interest rates to near zero in order to bring down borrowing costs, and we've also committed to keeping rates at this low level until we are confident that the economy has weathered the storm and is on track to achieve our maximum employment and price stability goals. Even more importantly, we have acted to safeguard financial markets in order to provide stability to the financial system and to support the flow of credit in the economy. As a result of the economic dislocations caused by the virus, some essential financial markets had begun to sink into dysfunction, and many channels that households, businesses, and state and local governments rely on for credit had simply stopped working. We acted forcefully to get our markets working again, and as a result, market conditions have generally improved. Many of the programs that we're undertaking to support the flow of credit rely on emergency lending powers that are available only in very unusual circumstances, such as those we find ourselves in today, and only with the consent of the Secretary of the Treasury. We are deploying these lending powers to an unprecedented extent, enabled in large part by the financial backing from the Congress and the Treasury. We will continue to use these powers forcefully, proactively, and aggressively until we're confident that we are solidly on the road to recovery. I would stress that these are lending powers, not spending powers. The Fed is not authorized to grant money to particular beneficiaries. The Fed can only make secured loans to solvent entities with the expectation that the loans will be fully repaid. In the situation we face today, many borrowers will benefit from these programs, as will the overall economy. But there will also be entities of various kinds that need direct fiscal support rather than a loan they would struggle to repay. Our emergency measures are reserved for truly rare circumstances, such as those we face today. When the economy is well on its way back to recovery, and private markets and institutions are once again able to perform their vital functions of channeling credit and supporting economic growth, we will put these emergency tools away.
So, we don't need to see
At Lexus,
that guy.
we knew from the start.
So what we see here is basically a discussion by Jerome Powell of what can be done from a monetary policy standpoint, which would be increasing the amount of credit, increasing the amount of money supply. So as I've talked about even in class before, obviously the one concern then has to be that will start to cause some inflationary pressures. But really, the most that the Federal Reserve can do is try to create some stability by the fact that we know that if you need money, it will be there to be lent to you. Now, how much? $2.3 trillion. That's a historic amount. That's just historic. I don't know what else to say. But not only is the amount historic, but also here, look at the sub-bullet points here. It's where the money is going. So probably the biggest one of at least some concern among some economists would be, including myself, would be sub-bullet point number 3. That would be high-yield bonds that were recently downgraded from investment grade. That's a somewhat nice way to say junkier bonds. Not necessarily junk bonds, but junkier bonds. So we're talking about B-level, B-graded bonds. Anything that's, so you have A and B rated bonds. A's are the best; those are considered investment grade. Anything B, B minus, B, double B, those are all non-investment grade. Meaning, when we say investment grade, we mean life insurance companies, orphanages, it's not risky. It's not a risky bond, and so it's appropriate bond for anyone to buy. You're not going to lose any money from it. The yields are going to be very low. The interest rate's going to be very low. If you want to increase the interest rate, you have to take on more risk. The way you take on more risk in a bond is by lending money to people who might not pay you back. And that's what the Federal Reserve is doing here. Now, the consequence of that is that you are now lending money to people who might not be able to survive the crisis. Maybe they can't survive the crisis because this was just such an unexpected event that it's hurting every great company. But maybe you were not a good company to start off with. So one example that I've been thinking about today is a company that is rumored to be declaring bankruptcy soon would be Neiman Marcus. Well, Neiman Marcus already had low-graded bonds because it's a physical retail store without a very good e-sales, internet sales structure. So they're clearly behind the times and their business is suffering. It's not getting bailed out because it turned out that their bonds are actually just far, far worse than that. But you could imagine other companies that are not as bad as a Neiman Marcus or like a JCPenney or Sears or Kmart, whatever. But, less than like a Costco, somewhere in that middle where those securities could be purchased. But then also you see here too, and look at this one, Federal Reserve buying corporate bond ETFs. buying bonds in companies, not just government securities, but in companies. Corporate debt, corporate bond ETFs. I mean, the line between the Federal Reserve buying corporate stuff is unprecedented. The Federal Reserve is used to buying municipal bonds, government bonds. And on top of that, if the Federal Reserve makes bad loans, the U.S. Treasury will at least be able to, will cover the first tranche, meaning the kind of the first like portion of the losses that come when the money they lent to money to doesn't, when they don't pay it back. So what this should be a signal to you of. I mean, obviously we're hearing things of like how fiscal policy, how the federal government is spending a lot of money, like on the stimulus payments and more unemployment insurance, and there's that whole small business loan program. And all that's fine and good. And there's obviously a lot of politics involved in it. But the monetary policy just doesn't get enough press because it's a bit more technical. But I'm hoping at least you see here from the first few slides here is that it is also very significant in size. Okay, so now I can start to get to some of the data here. The first big one, the one that that the chairman alluded to, Chairman Powell alluded to, was going from a very, very low amount of unemployment to much higher. And so these are initial jobless claims, meaning the first time you go to the unemployment office to file the claim or go electronically to file it online. And you would see here that for each of the past 3 weeks, we have actually been exceeding what the estimates were. So we now have, 15, 16 million people out of work already, out of a labor force that's not that large. So 3.3, 6.9, 6.6. I mean, look at that. If we look at the Great Recession again, this would be the Great Recession. From the point of how many were lost during the worst part of the Great Recession, that total was 8.7 million. We've already exceeded how many people lost their jobs during the Great Recession. Now, since the Great Recession ended in 2010, over the past 10 years, we've created 24.8 million jobs. Obviously, the amount lost in the last 3 weeks is already taken over half of this amount. So the longer the shutdown of the economy goes on, the more these job losses occur. Now, it's obviously not equal, but obviously here for Hawaii, pretty bad. That would be 79 out of every 1,000 workers. That is the, as I'm looking at this quite quickly here, that would be the highest in the United States. That's not a laugh of it being funny, that's a laugh of it being very, 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 very bad. That even the scale goes to 78 and we are 79. That is the deepest shade of red on this map. That doesn't scare you in this lecture. I don't know what will. Dude, who gives a fuck? About California then having the most jobless claims. I mean, by numbers, this is 2 million job claims. We don't have that size here in Hawaii that would be everyone plus more. But on a per capita basis, we're obviously the highest in the U.S. And you see this here. I like showing these just because it shows an interesting thing. People looking at how do you file for unemployment. We've reached some peak and it's now declining. So we did hit this first surge, but as I indicated in the second slide, we have to now wonder, are we going to hit a surge again where people start to look at how do I file for things? And this again is our first chart that I showed here. Nothing that interesting. Okay, so now let's look at the expectations, how expectations are being formed. This is pretty shocking. I mean, the last time we've had as big of a shock as this would be Trump with the trade issues. So you have to go quite a bit back to get something that rivals what's happening now in terms of the negative surprise. And the way that you start to see what's the fallout from everyone being unemployed, well, the next fallout would be people starting to miss their mortgage payment. And you're going to start to see that here, right? So this would be saying, what was the highest amount we ever reached for people not paying their mortgage back during the Great Recession? That was in January of 2010, and that was 14.3%. 7.9 million people not paying their mortgage, 14.3% of mortgage loans going bad. Most recently here, back in February, it was 2 million people unemployed, 3.7%, 3.7% of loans not performing. Now, we're already going to exceed 10% unemployment. So already with that, we're going to be at 7.5% of loans going out. That's 4 million people. So we're definitely already at the halfway point of the Great Recession peak. And with just very small increases here, especially again in Hawaii, where we said we have 30% unemployment, that would be phenomenal. That'd be 1 in 5 mortgages, not of people missing their payments on 1 in 5 mortgages. The only commentary I can provide on that as an economist would be that if you expect that the homelessness problem or house insecurity problem is high in Hawaii now, it's certainly going to be much higher when people lose their job and they can't meet their mortgage payment. And you see, obviously, missing a mortgage payment, that would be like the last kind of payment you'd want to miss. What about the other stuff, right? And who is it that actually owns these bad mortgages? Well, it's not Banco or First Hawaiian necessarily. It's Ginnie Mae, Fannie Mae, Freddie Mac. These are all government-based agencies that own it. That's all of us. We are the owners of Ginnie Mae, Fannie Mae, Freddie Mac, because we are government, we are taxpayers, and all of that is increasing. So the true consequence of what's going on is going to be much greater. And where do we see that, right? Google searches for the term forbearance. That would be forbearance on loans. Pretty darn high. So what I'm trying to show you here in these slides is that the degree to which we're seeing the economic fallout from the coronavirus, we're nowhere near seeing that. So, for me personally, it looks less likely even if we fix the first scenario where we say that everyone's just going to go right back to work and everyone's going to start working again and we're going to get back to our old situation, all of this seems to indicate that people are already missing their payments, that the harm has already been done. And then you've got homeowners then that are delaying selling their home, either because they are not going to move themselves, they lost their job, they're not going to be able to get the price they want. So this would then start to be your cooling down in the housing market. And we're reaching the point in terms of how consumers feel about the strength of the economy, reaching points where that's declining to the points we saw during the Great Recession. I mean, look at the speed at which that decline occurred. I mean, that's nearly a vertical line. And that's the sentiment. And then in terms of current conditions, again, same thing. Instead of sentiment reaching again Great Recession points. And unfortunately, the gap that existed between emerging economies and an economy like ourselves, that gap is now eliminated. So we're just as bad off here in the United States as it is everywhere else in the world. People are not buying durable goods. This would be like washers, dryers, furnaces, air conditioners. No one's buying durable goods. What does that signal for an economist? You don't buy a durable good if you're pessimistic about the economy. You only buy a durable good when you're optimistic about how things are going to be. So, when do people expect that things will start to return somewhat to normal? The majority think June 1st. right? We have politicians are obviously pushing it to be sooner rather than later, but again, the overall sentiment, what do we know? We're not doctors, but it seems like the overall sentiment is that it's still going to be over a month away. Who knows what that looks like. This is the inflation rate. As I indicated earlier, the printing of all the money obviously causes some pressure in terms of inflation. We're not going to see that yet, but you can. But what we would expect to see is that this will start to increase a bit more dramatically as we get on in the coming months. And all we're seeing now are falling prices, which isn't a good thing. We do have some level of deflation in the things that you would expect. Obviously, oil prices are very, 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 very far down. In fact, today, the price of oil delivered in May was negative, meaning no one wants the oil that's out there. Airlines obviously down. No one's buying clothes. The only thing that's up in price are cleaning products. Housing prices are stable, but again, we're going to imagine that this is going to fall in terms of shelter because people are going to be losing their homes. Hotels, hotels are super cheap right now, and that would obviously be seen right here, as low as what they were during the Great Recession. So you see in all this data I keep showing you, it's all referring back to the Great Recession. And even right now, well, as of last week, as I captured this data, right now, things are as bad as the Great Recession. So the longer it goes on, the worse it becomes than the Great Recession. Airline fares down, as bad as what we saw during the Great Recession. Inflation expectations, well, right now, they're pretty low because we're expecting that we're going to be in a pretty big recession. But they're obviously going to increase later because we've printed so much cash. And what that does here, right, is that we start to see these things of like, how do we see an economy in a recession? Well, one aspect of this is people traveling less. I mean, look at these numbers of how few people are now traveling. How many planes are just sitting around, right? And then let's look at how much money is sitting there in cash by the U.S. government, right? It's almost $1 billion that the federal government has at their bank being the Federal Reserve, ready to spend. They have a bunch of money. And look at that. Compare that to the Great Recession. What does that say? That says that basically, unlike the Great Recession, where the Great Recession, the total fiscal package was $750 billion with a B, we're now talking about trillions of dollars. That's with a T. That's $1,000 billion. So the scale of what we're doing now is just so much more immense than what we did in 2008 and 2009. Now, I wanted to deviate a little bit in this lecture, and I wanted to start to talk about our biggest trading partner, Canada, because what happens there obviously affects us as well. So in Canada, same thing. You're seeing a huge decrease in the number of workers in Canada that are those that are becoming unemployed. I mean, look at that. I mean, that's in terms of how quickly it's happening. Remember, they spell labor with a U. How quickly it's happening, that's unprecedented. Look how long it took for these other recessions for you to reach those falls in jobs. We're already there, less than a month. And in terms of the unemployment rate, obviously it's going to be historically high. It's already reaching the point that it would have been in 2008, 2009. The labor force participation rate, meaning the number of workers you have actively working, historically low. Where is it? Same things. Well, this is a misspelling. I copied this chart, so obviously I did not make it. But same sectors, accommodation, food services, same sectors as here. Same response by the Bank of Canada. That would be the central bank in Canada. Same response. Print lots of cash, and you certainly see this here. This is 275 billion Canadian dollars. So smaller scale, but still a dramatic increase that dwarfs what was done in 2008, 2009. And what you should see from this that's somewhat concerning, if you're an economist, would be the greater number of colors. This would be the central bank in Canada, the Bank of Canada, buying more commercial paper, meaning more corporate bonds. The more colors there are, the more dangerous the balance sheet's becoming for the central bank. Now, let's look at the stock market. The stock market, well, the past 3 weeks has done pretty darn well, reaching a point where the markets are now down, not not that much. I mean, for the year, I think it's still down 10 or 15%. We're basically back where we were a month ago. I'm not entirely sure why. I mean, I've been asked it many times by my wife, especially, but I can't tell you why that is. But this I completely agree with. If we look at the economic threat that COVID-19 poses, the amount of the sell-off has been dramatically less. And I'm not sure exactly why that's the case. It just seems like investors are overly optimistic about the speed at which the economy will resume. And you see this right here, that it was quite quick how quickly we went from the peak in February down a third by March. And now we are, I mean, we're not obviously recovering at this point, but it was quite quick. You saw it again in 2018, fall of 20% in a very short period of time, and then recovery. Nothing like the stock market falling 86% over the course of 3 years and then taking over 2 decades to recover. Or even during the Great Recession, the market's falling by over half in the course of 1.4 years. And then taking 4 years to recover. That volatility that you see in these first 2 rows is somewhat concerning. Obviously, companies are asking for a lot of money. This would be commercial and industrial loans. Their demand for money is now approaching $3 trillion. Now look at that. Unlike the 2008-2009 crisis, companies are actively going to the markets to borrow more money. So they are, one way to interpret this is that they are building up their balance sheet to prepare for an extended recession. So companies are, even though they might be saying we're optimistic things are going to resume quite quickly, they're out there asking for lots and lots of money to prepare for the fact that it's not going to resume quickly. And you see this here, that that businesses are building up their assets. That banks themselves are also holding lots of excess reserves. Banks holding excess reserves is that banks are also a business, and they are preparing for the fact that this is going to be a long recession where they need a lot of money to cover perhaps bad loans or other things. The money supply has obviously increased a great deal. Again, that's putting inflationary pressures, the likes of which have not been seen in my lifetime. And you see then also consumers are also building up their cash reserves. So consumers obviously build up their cash reserves during in anticipation of a recession. Look at your own spending practices. You're probably not spending as much, and you see that growth here. Okay, so that unfortunately is a rather dismal way of looking at the current state of the economy, but what I hope to do in next week and the last weeks, this coming weeks, which will be the last lecture, that I'll be able to give you, I'll try to be a little bit more optimistic as much as I can about the state of the economy and where we might end up from with that.